With AI fears and volatility rising, is it time to look outside the U.S. for better returns? Our next guest thinks so. Elizabeth Burton is Goldman Sachs Asset Management Client Investment Strategist. Welcome back.
Thanks for having me.
All right, so we've spent every day talking about this equity market, and you want us to look elsewhere where the returns have been good.
Yes, we just put out our 2026 outlook. 'Tis the season for next year outlooks, right? And our theme in equities is get out, get down, get caught, and get active. So in terms of down and out, down and cap, out of the U.S., couple places to look there. I know you had my colleague on talking about small caps the other day. We're still constructive on small caps in the U.S. and outside the U.S. We are.
All right, let's start there since you went there, because that's probably going to be the if there's a controversial take, that's going to be it.
Fair enough.
Why?
Well, for one reason, we're thinking about diversifying portfolios. So if you think about small cap growth in particular, we've seen a lot of our clients asking about low volatility strategies, extension strategies. One of the benefits of strategies like small cap growth is you can capture more upside. Obviously, you're going to capture more of the downside, but you're not having to give up the upside like you would in a low vol strategy or potentially on the downside in 130-30, 150-50. So there's that. Also, intra-stock correlations and inter-stock correlations in the small cap sector are at historic lows or multi-year lows, 5 to 10%. So we think that there's a lot of opportunity for alpha in the space. And it's a part of investor...
we've underperformed. I mean, relative to the other market, we're up, the Russell's up 6%, a little shy of that year to date.
Yeah.
A lot of that depends on the rate picture.
Yes.
Right?
That is part of it. And the growth picture.
And the growth picture.
That is definitely a part of it.
I feel like we're having questions about both.
You could have questions about growth, but it's also a good way to play or an interesting way to play the AI trade. So you can get some of your thematics in there as well. I get that a lot of people had to defend their small cap views and their small cap exposure lately, but I sort of like asset classes that you have to defend because it means a lot of folks are avoiding them. You know, another one of those is real estate. So we've been waiting for a time to get back into that market, and that's starting to look appealing, at least on the debt side as well right now. Okay, so it's fair to be a contrarian. Overseas. So I think it's emerging markets and Europe maybe have outperformed the U.S. this year. Right.
Why does that continue into next year? And what's not known about it now?
Well, so I'll take your question a little bit differently. In terms of emerging markets, on the broad, emerging markets have outperformed the U.S., but on a single country level, that's not completely true, right? So one area that we've moved, that our analysts have moved underweight to overweight is within India. So EM up 20-30% year to date, India specifically only up about 3%. And then a lot of the headwinds that caused the underrating last year are now constructive for the overweighting this year.
That's interesting because we've been hearing a lot about India as being a favored place. The reason why it's underperformed this year is what? The trade war? The tensions that existed between the U.S. and India, which are obviously still there? I
think that might have accounted for some of the uncertainty in the pullback. But if you think about this time a year ago, India was at trading at a 25 times multiple. It's retraced back to a 23. Its premium versus other EMs was in the 90s. Now it's closer to a 45. They had a lot of headwinds going on there. But now we've seen government reforms and policy reforms that should be constructive. We see tax cuts. We see policy cuts, bank deregulation. So it's an interesting place to look for opportunity.